Much really depends on those profit margins and expected profit margins going forward, especially in the case of wheat. And that leads me to another slide, and I found this one kind of interesting because farmers tend to vote with their planners in terms of looking for acreage that is profitable and commodities that we're devoting to each crop. And you can see that we've seen some losses in wheat and some of the gains in the other row crops, and so they're shifting acres to find something that is paying the bills and also that is at least allowing them a little breathing room given the cash rental rates that they're being exposed to. And where we go from here really depends on, once again, those expected profit margins and those. And I'd like to think that our enterprise budgets can really help clear the muddy waters and help these farmers and producers determine what crops would be in their best financial interest. And chances are, if it doesn't look good on paper, they won't be able to, plow a profit in real life. And so I think it'll make or save them some money and some stressors down the road if they do their homework. And I think budgets are a large, a component of that. So let's shift gears a little bit and look at the pasture values and rental rates over the years and a perspective of that. And once again, this is available from NASS, and this is a composite of pastures, native grasses, rangeland out west, improved forages back east. And so you can see how these trends and patterns have changed over the years. I think one takeaway you can see here is that, once again, there is a relationship between the two, but there appears to be even a greater disparity between the trends over the years. And so, for instance, the pasture values have appreciated almost tenfold over the past 50 years, at least according to NASS. The land rentals have increased about 300% or threefold. And so once again, there is a relationship between the two, and both of them are relying on those farmland earnings, but I think pasture land to a lesser degree relying on those farmland earnings than what those rental rates seem to indicate. And once again, there's a lot of urban influences on those pasture land tracts around the state. I think recreational interests play a part of that. And, you've got a number of buyers that are willing to pay for that lifestyle aspect of buying some pasture ground. And so then, according to the same information, you boil it down to the county level, the highest cash rentals obviously are in those highest productive forage-based growing regions of the state, the highest quality and quantity of the forages that are grown, which really support your higher stocking rates and carrying capacities. And that's in a little bit in the central portions of the state, but especially in the Northeast. So also, at least from OSU, and this is available in our current report 216, is that we can differentiate at least a little bit by the type of forages that are grown around the state. So with native pasture, we didn't really see much of a change there over the past, say, 2 growing seasons. But with improved or introduced forages like Bermuda grass or other pastures, which is really meant to be other improved type of forages, we did see some adjustment, and we did see some declines in those rental rates of a few dollars per acre. And so that may beg the question, well, what's going on in, with the pasture land markets? And so I think it's really influenced a great deal by those operating margins in the cow-calf sector, because the beef cattle economy is the major beneficiary of the forage base in the state of Oklahoma. About 2/3 of the farmland base is in pasture. And of course, the mama cows operations is the big component that's utilizing that forage here in the state. And so how these operations are faring around the state really has a major impact on those land rentals. And This is sort of a composite, a national sort of an estimate of how these small cow operations are doing. But I think you can translate these numbers into Oklahoma. And, for 2019 and 20, it's been a tough go for a number of cow-calf producers around the state. And, especially in 2020. And, hopefully we can turn things around beginning this year and then going into 2022. But, so far this year, it's been a tough go as well. And, that will have a direct impact on those pasture land rentals going forward. Anything that's impacting those earnings, especially, the prices that they're receiving for their calves, will have a big impact on those expected, rentals that they can pay down the road. But also, the feed supplies, pasture conditions, water availability. And we've been very blessed in Oklahoma. I mean, compared to the states out further west and even north of us, we've had at least more moisture in our soil profile, and our pasture conditions are much better off than what they are further west. So hopefully those conditions will continue, especially with rains that we'll receive this month. Now, this particular slide, I think, is really important to bear out in terms of at least presenting those overall relationships between the ownership transfer market with the rental markets. And this is simply the rent to value ratio, and it's the rent divided by the underlying land value. And this gives you sort of a benchmark of basic earnings associated with land utilization, whether it be cropland or pasture ground. One, I guess, takeaway that you can see from this particular slide is that, generally speaking, cropland has a higher ratio. Well, why is that? Well, it has a higher earnings potential, better quality soils, higher fertility, a more productive asset. And so you expect those earnings to be a little bit higher than pasture ground. And then you may wonder, well, what about that downwards trend? What's going on there? Well, that's really reflective of the fact of the matter is that land values are appreciating even more in a relative sense than what the underlying land tenure markets are appreciating. And so those earnings in terms of a rate of return is dropping, or it has dropped over the I would say past 10 years or so. And you may wonder, well, is that a big concern? Well, in a low interest rate environment, it's not a big concern because you have a number of active farmers and ranchers, as well as even outside investors that are willing to live with lower rates of return, because what's the alternative in a low interest rate environment? The potential of alternative investments like a 10-year treasury note or a 30-year treasury note. Those expected earnings are right there with a land investment. And land to a number of individuals, even with your outside investors, are thinking, well, it's a storehouse of value. And I think that, and they may think that those rates of returns are very competitive with where they could take their money elsewhere. So it's really reflective of the low interest rate environment also, is why we are seeing these lower earnings that are being shown here. So I'm going to shift gears over to cash leases and how to create an equitable cash lease. And, I could spend really a whole presentation on crop shares. Also, that'll be a different presentation for a different day. But I really wanted to focus on cash leases today, and hopefully provide you sort of a bucket list of how to encourage your producers, or even ourselves, sort of a takeaway bullet points on how to develop a equitable cash lease that both parties can live with. And essentially, in a cash lease, the tenant bears all the price of production risk. They repeat the benefits of their management expertise and knowledge. They are exposed to all the production and price risk, and they should be compensated for that. And so they're paying the landlord a fixed amount essentially per acre per year. It may be over several years, or maybe just 1 year at a time. Many times these agreements, and we're seeing this more and more in the cropland growing regions in the upper Midwest, they have a flexible component to where, say, the base cash rent is tied to a historical either price or yield. And if the actual price or yield is higher or lower than the historical, then the base rate for that cash lease will be adjusted either up or down. And that does allow the tenant to share a little bit of that price and or production risk and resulting financial risk with the landlord. And of course, you know, if the landlords are agreeable to that, essentially what happens is it's in a year of higher earnings, the landlord shares in some of that wealth and happiness. In a year of lower earnings because of lower prices or lower yields and or both, they share in some of that pain, you know, that the tenant is also experiencing. And so it is a way to share some of that risk that's occurring out there in production agriculture. But in many situations, they can make it work for a cash lease. And so once again, we're seeing more and more of that all the time. In determining a fair cash lease, I think there's a bucket list of items that we really need to think about when it comes to some particular items to sort of check off. And if the decision is to rent for cash, one good starting point is to determine what, you know, the going market rate is. And so, you know, you can refer to OSU's numbers or NASA's numbers or somewhere else just to get what, you know, the going rates are. And then also from the landlord standpoint, they need to think about, well, their particular costs, you know, covering their real estate taxes, plus maybe a desired rate of return on their land investment. And then the operator or the tenant essentially needs to worry about, well, how much can I afford to pay? You know, what's left over after I pay my bills, you know, from my revenues, and what kind of margin do I have left for that, but you know, that potential cash rental that I might have to pay. And so when it comes to determining, you know, those going market rates, these are the sources of information that I just threw out there for your information, as well as NASS, our publications, of course, the Kansas City Fed. I'd like to remind you that these are actually some good sources of information, but they should only be used as guides, because our quoted rates, as well as the other quoted rates that you can obtain here, are not necessarily right for your piece of ground. There's a lot of particulars that need to be factored and adjusted into every negotiation. But I think it really does serve as a good starting point just to see how those going market rates have changed over the years. So then I want to briefly go over a sort of a budgeting exercise when it comes to the landlord's cost plus the return to equity, and probably determine an initial asking price, okay, at the bargaining table. So, you know, they may have some cropland that is valued at, say, $2,000 per acre. And so given that gross rent to value number that I showed earlier in that one slide for cropland of 2%, well, that gives an annual charge of, say, $40. And then they need to cover their ad valorem taxes. And they may have some land improvements. I'm not going to include that here, but certainly they may have that situation. And so they have a total cost that is right around $46. And that would probably be something that would be their initial asking price for that piece of ground. Certainly something better would be great, but this is something that they'll probably start off in terms of, you know, from a standpoint of their seller's asking price. So then from the landlord, or excuse me, the tenant, they have to go through their own sort of budgeting exercise, and they have to go through a procedure to estimate how much can they afford to pay for that land in form of a cash rent. And so, first of all, they need to think about the revenue side of the equation. So if they have wheat ground, and I realize this is 550 wheat, but this is sort of for the long term. They have rates of about $220 per acre. Then they need to think about their cash or variable costs, and those costs are about 130. Then their ownership cost or capitalization cost and machinery cost could be a certain amount. I think they need to be compensated for their labor. And also they need to be compensated for their management expertise and their willingness to be exposed to that risk of price and production risk. In this case, I've got 5% of the total crop. It could be as high as 10, but I threw 5%. But I think they really need to be compensated for their management efforts in their operation. And so their total production cost could be about 180, which leaves about $40 clear for a possible land rent that they can afford to pay. Okay, so that's probably from the standpoint of the buyer's initial asking price. So what do we do with those numbers? So, you discuss all three of these methods, and it, really does present some differing viewpoints in terms of some asking and desired selling prices, and I think it does help both parties provide some transparency and some justification on where we're coming from and kind of setting up the lay of the land when it comes to the initial desired prices by the seller and by the buyer. And so it really does determine those ranges of the seller and by the buyer, and then hopefully finding a compromise between the two in that green zone. So to sort of reiterate how we're going to approach this, let's start with the landowner. And given their situation, they'd like to see at least $46 or more. They may have a walkaway price of something lower than that, maybe $42. And if the tenant can't afford $42, then that could be the deal breaker. All right, we're just going to have to walk away from it. And then, the buyer, which is the tenant, they have an initial offering of $40. Less would be greater or better, but $40 would be something that they would at least initially offer. But they may also have a walkaway number that's higher if they can find value in that. And that's really the key, is to find and create value behind the numbers, because that zone of possible agreement doesn't have to be a hardcore battle zone over money. For example, maybe the tenant would like to access some hunting rights on that particular parcel, and that might be worth a few bucks to them. And so they might be willing to pay a little bit more for that opportunity. Or maybe, the landlord might be willing to back off of their initial $46 by compensating the tenant if the tenant is willing to make some improvements in the property. For instance, improve the stock ponds or clear out some fence lines. That would allow, I think, and justify maybe the landlord to back off and to lower their asking price and compensate the tenant for their sweat equity. And then also realize at the same time that, hey, the tenant is willing to do some work on maintaining or improving the value of that particular parcel. So really, it's important to find some value within that zone of possible agreement. And many times lease negotiations are quite stressful. But it really doesn't need to be that way. I think a lot of that stress comes into play from a lack of preparation, a lack of communication. And that, when you have a lack of preparation and communication, or somebody that's stealing all the conversation. It's like a one-way street. And a lot of times that kills the deal. I think it's important for both parties to do their, darndest to do their homework, to be transparent of where they're getting these numbers from, identify the facts, and understand the other party's point of view. And that really involves being a good listener. I think you can enhance the conversation by being a good listener, and I think that does help improve the odds of reaching a compromise within that zone of possible agreement within that green zone. So everyone is giving up a little bit, but they can walk away from the table still feeling satisfied, and it's still a win-win situation where everybody has skin in the game. So once I think the parties reach whatever agreement that they had in mind around the table, I would highly recommend putting that agreement and all the terms and provisions into writing. It really protects both parties and allows for clear communications between them. I think it helps both parties understand their rights and privileges and their duties involved. And it obviously, when it comes to a legal resource and a guide for heirs, should one of the parties die before the term is over, at least the heirs have something to refer to. It serves as some great documentation for the tax man, for your tax preparer. And, if there is something that's left out, some issue that just can't be resolved, I would consult with some legal counsel that, is agreeable to both parties, that really doesn't have any dogs in the hunt, that can provide some unbiased advice or guidance as to resolving that issue. He or she may still charge, obviously, they're going rates, but I think it's really money well spent to have that issue resolved. And by the same token, then incorporate those solutions into the next round of negotiations, or even immediately incorporate into that agreement as sort of a codicil or something like that. But anyway, it would really, I think, pay dividends to have someone from the outside that has some production agriculture background look at it in case there's an issue that can't be resolved. So with that, I really appreciate your time and attention on these particular topics. Hopefully I gave you, the viewer, some feel and flavor of some historical perspectives on the market, and then also how to go about creating an equitable lease, and checking out those ticket items on that list. So Brent wanted me to remind you to fill out that survey link by copying that particular link into your browser. Feel free to fill that out. We really appreciate your impact on how to improve these outreach presentations down the road. And in case you have any immediate questions, I'll be here for that. But if you have any questions or comments, my contact information is there. But short of everything else, once again, thanks for stopping by, and have a good rest of the day. And I'll turn it back over to Brent.
Thank you, Roger. And I also shared the link to the survey, the webinar survey, in the chat box, so you can click on it through there as well. I would like to let everyone know that our next webinar will be on June 8th at noon, and it will feature Dr. Kim Anderson discussing how to take advantage of relatively high crop prices that we're seeing right now. So I've enabled chat and audio, so you can either, if you have questions, you can either ask it through the chat box, or you can unmute yourself and ask it that way as well, if there are any questions.
Roger, I had one today that asked me what would be the rental rate through the growing season.
Well, I think the publications that we've got for, are you referring to like pasture ground?
Yes.
Yeah. Well, you can break it out like say so many dollars per head probably on that. And unfortunately, we don't have that number directly presented in that current report 216. However, we do have the typical, I would say, stocking rates for a, a particular type of forage by region of the state. So you could determine what that number could or, should be, depending on, that number per acre, and then breaking it out by how many head are we running over however many months that we have in mind. So you can kind of determine that number through the back door, but I think those numbers are available in our publications.
Okay, thank you.
You bet. Good question.
Are there any other questions for Roger right now?
Well, like I said, if you got any questions down the road, give me a holler and rattle my cage, and I'll be more than happy to get back with you. But let's hope that with the rains that we're getting this month and that we're expected to receive this month, that at least that will carry us through the drier growing season, and we can at least produce some hay also, not only to support our own cattle industry, but provide some support for those that are, much less, they're more at disadvantaged when it comes to feed supplies.
Well, thank you very much, Roger, for presenting today and answering questions. And thank you everyone for joining us. I think I'm going to wrap the webinar up now. So we will see you on June 8th at noon. So thank you everyone, and we'll see you then.
Okay, thanks a lot, guys.